All right. We are live once again. Exit Liquidity coming at you on X and YouTube, or the app formerly known as Twitter. I have with me, as always, the great Captain Rational.
Hello.
And we are going to riff on the market as it has come to us today. And it's been exciting lately. There's things are moving around. Vol has returned, taking out those that were over leveraged. They have been swept into the currents of, you know, being on the wrong side
Oblivion
of the position.
being directional exposure versus spot expectations. Expectations are so skewed and so broken, and we come to really the state of society. And that's why I will continue to talk to my very microscopic audience, and that will be the way it is in the future. And the few have that survival mentality or capacity to navigate, and that unfortunately is merely an extension of everything that has been done in society and with financials historically. How else could you be cool, calm, and collected during periods of volatility like this without thinking about the system differently?
Yeah. I mean, I have been incredibly comfortable sitting in my spot bags. I did not make insane amounts on the way up, uh, the way some that did make copious use of leverage were able to. However, many of those were unable to keep it in the bloodshed. So
I was just
that is
talking
just the
with some
game I
folks.
choose not to play.
Yeah, expectations. I am firmly against the concept of richness or how it's interpreted by the general public. Well, what the fuck is the point? Listen, you guys, if you had every single one of your bills paid from income, not from work, you would feel different waking up in the morning. You would feel better.
That would be
And
awesome.
then the
I
right,
am not there
but
yet.
and then extrapolate forward. So if you and this is like dividend investor mentality, historic dividend investor mentality. It's and you build income over time. But you can't do this in traditional finance. If you do this in these crypto markets and you get to the point where 10% of your bills are paid, 50%, 75%, then 100%, and then you roll it a cycle. And you roll it two cycles. And there we talk about a person in their 20s when it's like, all right, two cycles, 8 years, you're 28. I'm 41. You have all the time in the world. Roll it two cycles, give it 8 years. And then you
Yep.
go from your bills being paid to now all of a sudden 10 times your bills are being paid because this entire damn market is monetizing.
Yep.
And this market isn't a market, it's an emerging market of emerging markets. This is akin, metaphorically, to nation states coming online with favorable tax jurisdictions, regulatory conditions,
Yep.
interest rate arbitrage opportunities,
And all
scale
the
and
brightest minds in the world working to grow the economy.
everyone has the wrong expectations.
Yep. So, sorry.
That was my
I
rant to
been
start.
Yeah, that's a good one. That's a good one to kick it off. I'm recovering from a cold here, so you may see me hacking and whatever. But we did get a question that I do think opens up a very important discussion, and that is somebody asked, good morning, guys. What a pleasure to watch you live. Move going insane with geopolitical tensions. Is it just noise? Now, I think it's important to state that, like, almost everything comes down to positioning. Geopolitical stuff, like, it is just the campfire that starts the wildfire, you know? Like the conditions were already set when that whatever geopolitical thing happens. The conditions were set in such a way prior to all of that. So is it because that, you know, somebody, accidentally sparked something and started a fire? Or is it that that fire was going to happen one way or another, whether it was a lightning strike or whatever, and this just happened to be the impetus that caused it? And
Yes.
to me, I'm far more into the latter camp, that like this big washout we've had in crypto and the big washout we've had in markets, it was all positioning. It was, people were positioned like the liquidity was just going to keep growing and growing and growing and growing without interruption, despite the fact that the tax man is like, give me
Come on.
all the billions that you owe me, and that money has to come from somewhere. And
It's
so
already spent.
it is,
But
but the in order to pay, you've got to find that liquidity somewhere. And so you're going to, in order to free up said money, it's not unusual for people to have to sell off, longer term stuff like stocks or bonds or whatever, in order to have to accommodate a big tax bill. And so maybe they will reduce their duration exposure going into that. And then some of it is just people expecting that people are going to do that. And
and
so,
then the market turns, and then the breath rolls over, BREADTH, and if the expected returns aren't there to the upside, everyone runs for the exits. That's
yeah.
capital gains.
Yeah. And so this is just, it's a positioning thing. And so you've got to just be aware that there's this underlying meta of this game that you've got to kind of expect that anytime positioning gets too one sided, it's going to revert at some point for some reason. And so, this is like what Captain's always talking about with, like, if you buy something that is super expensive, eventually it will become cheaper. Uh, but it also may get more expensive, you know, until it doesn't. And
Sure.
so it's all about positioning. If you don't get that spark that washes out the open interest, then
Expect it to go down. Said
it
your
will.
everyone, and if you buy at a discount, great, it goes up, it goes down. What matters is where it is in 8 years, 2 cycles.
Yeah.
Just don't pay a premium. Stop paying a premium. Everything was at a damn premium. Who the hell bought Arrow at $2 if he could buy it at a buck 60 or wherever the hell it's going?
Yep.
Buck 60. It's literally at a buck. You can't make this shit up. Don't buy shit at a premium. And if you can't buy at a discount, don't buy it. It's okay. It's
Yeah. And
okay to miss an opportunity.
it is okay to miss an opportunity, and it's okay when everybody's super excited to just sell a little bit,
Uh,
you know.
com- Complicated conversation.
Yeah, I
Capital
mean, I know
gains.
that you're not a capital gains guy. You're more of a buy productive assets sort of guy, but
I'm a sicko. I'm a sick person.
yeah, there's nothing wrong with that. It's a strategy. It is a cohesive worldview. But there's more than one way to make money in markets. But one way to definitely not make money is to just buy things that other people are excited about. And because if you buy into excitement, then you know you are buying
Someone else's bag.
closer to the top than you are the bottom.
I can't. I I am unable to process that kind of interaction with financial products. I don't, because fundamentally capital gains is you buy 10 people buy after you at higher prices, then the 11th is a sell, which means you are taking money from those 10 people that bought before you. So I'm unable to engage with financial markets like that. Ben, I lose your video? You're back.
Nah, I just turned it off for a minute. But
I can't do that.
I
I don't want
have
to do that.
magic powers. That's all right. So let's get to the charts, though. Let's
Yeah,
get to
let's
some
do it.
charts. And
Oh my God. Oh my God. That is a candle. That is a bullish engulfing candle.
it sure is. It sure is. Look at this. This, everyone, for those that are unaware, this is the move, which is what Leandro was talking about. It is basically an index that is comprised of a bunch of option contracts on uh, U.S. Treasuries of varying durations, and it's supposed to measure the volatility that is in the bond market. And for those that don't keep a key eye on the bond market is extremely important to all other markets. Like, this is the collateral that runs the world here.
Let's be more granular. The bond market is what manifests other markets. The bonds I define as money, and money is used to print currency. And currency, most people think of as dollars. So bonds create dollars.
They
Now,
do, and
obviously, this is a generalization, but
it
if you're
is.
looking at the entire structure of the system, that is a great way to reduce the vast majority of activity.
And something important to note is that the moneyness of these bonds
Uh,
increases with duration, or I mean, as you reduce duration. So a 1 month treasury is the most premier form of collateral.
and they've
and
shifted to the less duration recently, haven't they?
and well, the issuance has definitely shifted towards shorter duration, which means more moneyness, which means moving the duration of everything else shorter, which means, I mean, that moneyness is high powered money that is going to create more leverage than a 30-year treasury. Like, you would have to be kind of degenerate to do 50x on a US 30-year,
Oh my God.
just because the length of that particular uh product's duration
30 years.
is going to make some truly crazy swings depending on, what the market is doing. I mean, just look at what the 30-year has done over the past you know, year and a half, 2 years. Even since the pandemic, like, it has made incredible moves. And so the volatility of higher duration assets is going to be greater. And the volatility of a 1 month treasury, look at this thing. It's just chilling. It's just chilling. If this thing gets volatile, you need to look out, because it it tends to only get volatile when the Fed's moving interest rates around. Because this was rate hikes, right? This is just people trying to price in, oh, how much is the Fed going to move today? Is it 25 basis points, 75 basis points, whatever? Like, that is what the market is pricing in during rate hikes. And so if they expect slow and steady rate hikes, you'll get less volatility. If they expect big, huge, moves, then you're going to see big candles on this. But otherwise, you don't want to see volatility in your uh world's most money like asset. you know um Now the 10-year is like the deepest, most liquid treasury there is, and this actually is incredibly important to Lots of sort of long-term planning and stuff. This is the stuff that like pension funds and stuff are going to use, and corporates, and this ends up on the balance sheets of, you know, everyone,
Everyone.
indirectly or directly. And
Look at that chart.
so when this thing moves with like, look at the size of that candle. That is, you know, not the candle size that we see very often.
It tells you something very uh, easy to state, and you could state it in many ways, like the system is changing. All right, that's a little vague. I would probably best surmise a great description of this chart as the structure of money is changing. The composition, which maybe is expressed best as tapestry. The tapestry of money is changing. That's what this chart says.
Yep. I think another thing that's important to note is going back to this 1 month treasury. Why is this thing so steady? Well, part of the reason is because the Fed is actively controlling through open market operations what happens in this particular market. Um, and
What is
so,
what's that market called? Federal Open Market Operations,
yeah.
right? FOMO.
FOMO. Yep. Yep. And so the short end doesn't move around a lot for that particular reason, because the Fed is trying to control short-term interest rates because they know they don't have a chance at short of using QE or even QT doesn't really control the long end of the curve much. They don't have a lot of control over the long end of the curve.
Because it's all
The 30-year,
expatriated.
20-year, 10-year. Well, it's a huge market, and B, uh, there's so many different things that are baked into those prices that, you know, their mechanisms don't have a way of controlling that, because at the end of the day, the Fed deals in deposits at the Federal Reserve. They can control how much a deposit at the Federal Reserve is worth. That is about as short a duration asset as you can possibly get. That is the most like highest form of dollars in the dollar system, is a deposit at the Federal Reserve.
Because they could pay that liability.
They will pay that liability, or all hell breaks loose.
Look at
Um,
that central clearing that they instituted. Um, so what they want to do is bring it under their control so they can manage volatility, slow markets, and because obviously it's centrally cleared, they have more levers to pull. But
that
the
is
long end
what they
is
want.
offshore.
And so the short end, what they want is they want to be able to control repo. So the central clearing, uh, basically what the Fed is trying to do is they are trying to, there are different types of repo, right? And repo is where uh, different firms and entities go for dollar funding around the world. And what they do is they say, I've got a treasury, I want dollars. Here, what's the going rate? Dollars for treasury, and vice versa. There's repo and reverse repo. And so there's a whole market for this. And the thing is, some of it is centrally cleared through this FICC, uh, which is like the Federally Insured Clearing Corporation, I think. Um, but that is like central clearing. And then there's also just, I could, if I'm a, French non-bank and I want to enter into some agreement, repo agreement with
A
some French
bank.
bank or whatever, uh, what I can do is I can just uh, what is it, Societe Generale. Maybe I go to them and I say, hey, I've got this treasury. How much money will you give me for it in dollars? That is a bilateral repo agreement. And the problem that the Fed has is that there are times, and pulling up the move chart, you can see these times.
Yeah.
Like, look at this right here, April 20th. Look at
Wow.
uh, you know, right when the banks were failing in 23, and then during the global
Yeah.
financial crisis, um, even like
2020.
September of 2019, move spiked a bunch. Like, there are times where the repo market gets crazy. Um, and actually, here, this is a better chart for this. This is the US repo rate minus the RRP rate. And like, you can see these spikes here. Sometimes the repo market gets a little wild and out of control. And so when those things happen, uh, it can cause a lot of damage because you have a lot of people going for dollars that can't seem to find a place to get them. And
What?
so what central clearing does, because this is the problem they've run into, is that the liquidity of the treasury market, aka the move, because this thing tells you how liquid the treasury market is right here. That is liquidity and volatility, they are inverse. Like, if you have lots of liquidity, you're not going to be able to move it very, very quickly. Whereas if you don't have a lot of liquidity, you can move those markets and manipulate them or do whatever. And the the move is telling the US government that there's a problem here. That and the fact that this has been elevated to these levels, like, basically we're like at pre-global financial crisis levels, and we have been sitting at these pre-global financial crisis levels for uh since 22, and we've
Look at the
just been sitting
candle.
there. and
Look
and
at
look at
this.
this candle, look at this
Is this
candle
the
that we just
monthly?
had.
If move does not retrace, we are sitting on the largest month right now, April of 2024, of bond market volatility since, look at that, I think it's February of 2020. And then obviously we go back to the global, maybe 13, and certainly the
Yeah,
global financial crisis.
yeah,
Is that February?
yeah.
January
I
of
mean,
20,
we're
February.
we are in some interesting times here in as far as treasury liquidity goes. And so this is the problem that the Fed is trying to solve, because they realize that the entire world economy depends on US treasuries as collateral. And if they don't keep that market liquid, then bad things happen. And then the Fed has to step in and keep it from blowing up by expanding their balance sheet. And
So,
so, and doing QE and all the things that, you know, we've come to know and love about the Fed.
what for the viewers, why is volatility critical? If you have an instrument with moneyness, let's put it into crypto terms. You got a bunch of WBTC. I'm not even going to go into ETH territory. We're going to keep it clean. Got a bunch of WBTC, and that has varying degrees of moneyness. I think that's inarguable at this point, even for uh, big macro folks that say it's not a good store of value. They probably say, sure, you could sell it. There's liquidity associated with it, so it has some degree of moneyness. You could take it over to Aave and print currency units, dollars, money market. You're accessing. It's maybe a repo versus a euro dollar type of conversion of that instrument into dollars. So you're borrowing dollars versus printing dollars. But you're converting, extracting the equity from that collateral and acquiring dollars in exchange at an associated interest rate. So this is the whole world. Every dollar has an interest rate associated with it, and basically 99.9%. So the point is, when you have volatility in that instrument with varying degrees of moneyness, you hesitate, you stop, you freeze. Financial activity grinds to a halt. Why? Because if the interest rate is spiking, the price of the instrument is falling, which means your Aave health factor, you get a 4 instead of a 7. Like, oh shit, maybe I shouldn't borrow as much. because I could risk liquidation. And on the contrary, if the price of the instrument move is collapsing, is the price of the instrument's increasing, you can borrow more, you're getting a 7. But what happens if it's a 4 because of volatility? The world works only when volatility is low, because then financial activity can occur. When there's high volatility, financial activity grinds to the halt, and that's when risk starts to permeate the system.
Yep. And so this effort by the Fed and the Treasury to try to centralize the repo market, the whole point is to try to make it so that, I mean, there's a couple things. Like, why do you think the Fed, I mean, why do you think the Treasury spent so much money during COVID? Was it because they thought that much money needed to be spent? I don't think it was.
Of course
I
not.
think they saw what was happening in the bond market and they said, if we do not flood the system with treasuries, we are going to like blow up the world economy. And so the the pandemic made an interesting reason to do that. But like September 2019, the bond market was already starting to experience some crazy volatility, and repo rates were skyrocketing, and the Fed actually started doing repo in 2019, way before, like right about the time, for those conspiracy minded folks, that the COVID started spreading through China. But like, I think patient zero was somewhere around September 2019. I don't
Oh
I
my.
don't personally believe that those two things are related, but it is quite a coincidence.
Correlation
Uh
is not causation.
Correlation is not causation, but it is a interesting tidbit.
Yes.
Um anyway,
What would Mike Howell say? Mike Howell would say in September of 2019, banks uh, did not have balance sheet capacity to finance interbank lending.
yeah. And so that is like, that dollar funding is so important to the entire world that when that volatility spikes in the repo market, it spreads everywhere. And so, circling this back to the centralized clearing thing, the whole point is that, a, it brings it under central control, and so they can magically disappear any counterparty risk and make the world economy even more centralized and too big to fail. Because what happens if a counterparty fails when you have central clearing? Well, the central clearing house is on the hook for it. And
Who's
so,
backing them?
no, but yeah, so you've created more moral hazard. Now nobody has to do due diligence on their counterparties. So I'm sure that'll go swimmingly. But the other thing, but the thing about getting rid of that counterparty risk is what it allows you to do is, say I have $100 billion worth of repo, like longs on one side and shorts on another. Like, I can net those out to zero if they're with the same counterparty. That's in the current rules. I can net those out to zero. And so then I do not have a net position. Um, if you, the more counterparties you get in there that you can net out, the more you have freed up the capital efficiency, or hidden leverage, if you will, of the system. And so you can do more with less treasuries, which helps to alleviate this problem. And that
Delta
that
neutral.
that is right. You're creating delta neutral positions, But just because you're delta neutral doesn't mean you don't have risk. There's always
It's
gamma.
obfuscating the risk, and that's why they have to suppress volatility. That's the current state of the system, and right now volatility is exploding. To me, so much inspection reduces very much to this chart. It tells you when shit's hitting the fan, and when this chart eventually rolls over and collapses because the centralized actors realize, or they already realize that they understand how the system works. That's exactly why they instituted central clearing. They need to suppress volatility. And when they do, which they have to because the global financial system needs to continuously expand, it's the nature of a debt-based system. You have to finance debt servicing, which means GDP, productivity needs to increase, uh, and existing debt needs to be rolled over. And those conditions will be met. They have to be met. It's not an option, which means that is the expected. And we talk a lot about expectations. That is the expected conditions of this market in short order. End of the year, Q3, Q4, Q1, Q2. Obviously, I give you a yearly range because it's, I think, in terms of inevitability rather than time frames, destinations versus paths. This is the path. Path is bumpy. Destination is conditions that allow nation states to refinance their debt obligations. It allows for the allies of the United States to continue to have a functioning economy because otherwise they are no longer exporting and we are no longer importing. And now you no longer have supplies, goods, and services for the population. And that means the population is starting to experience social disorder. Because if someone doesn't get their favorite box of Pop Tarts, someone's going to be cranky in the morning and be grumpy at the office. And then their boss is going to be pissed off. And then their boss is going to go home and their wife's going to be pissed off. And then their wife is not going to produce their favorite cooking show on social media. And then that entire audience is going to be pissed off. So you get, so you see how bond market volatility affects your favorite boss's wife's cooking show on social media.
Yeah, there you go. It's science.
It's science. It's causality.
Yep.
It's cause, and that's why they have to suppress it. And they will.
Yep. And so this is also related to the whole central clearing thing. This also is related to the whole forcing everyone to move to SOFR instead of uh, what they were currently or what they were previously using, which is LIBOR, because so the interest rate that actually runs the world is SOFR. Now, previously it was an interest rate called LIBOR, which is the London Interbank Offer Rate, which is basically the amount of money that a bank would lend to another bank if for no collateral, just credit. Like how much would they lend? At what interest rate would they lend? And what happened was during the global financial crisis, the banks started they got scared. They were scared of all their other counterparties, and they just started saying crazy numbers that were crazy high because they were scared. And um, so that caused basically the global financial system to just break. And so the Fed said they were going to step in and do some things, and the LIBOR didn't change because the banks were still scared of each other. And so the Fed got pissed. LIBOR was not listening to them. It was making the Fed look silly because they were not in control of the global financial system like they had told everyone they were.
And
And
they have no control.
and they have no control, but they like the illusion of control. And
Is,
SOFR is something that they can create that illusion of control
and very do
over.
it very well. Isn't it interesting that the most fascinating thing that I take of this thought that you have now is merely the conversion of LIBOR into SOFR. Why? London Interbank. London. That's where financial, the hub, where everything, FX, everything started out of London. Why would, how would, imagine the conversations that U.S. had with Britain about we're going to take over this very critical rate. Can you imagine that? And London being like, oh shit, fine. Listen, I want the world to continue, so go for it. You do this. I understand why you need to take it over. I understand we ruled finance for the last 70 years, but I understand why you have to take it over. Here it is. That is just a remarkable structural change to the system, yielding this interest rate management back to domestic U.S.
Yeah, but
Regulators.
the key difference here though is that in doing so, we move the world from a credit based system to a collateral based system.
That's true.
And
That
the
was in '08, though. That we just they started all this conversation probably in '08, but obviously the move from LIBOR over to SOFR is recent.
well, it
Um,
took that long of arguing back and forth about because they kept originally they just wanted it to be one number. They're like, here's SOFR. But the problem is like there were LIBOR futures that like different durations for LIBOR. So that,
to
for risk
speculate.
management reasons, you need to be able to plan ahead. Like, what is my lending rate going to be in 1 month, 2 month, 3 month, 6 month? And so like you had products like SOFR futures that had to be developed and stuff like that
Yeah.
in order to be able to make uh this collateralized version of LIBOR become at least as expressive as the previous version of LIBOR.
They're
So
literally just SOFR and collateralized based system instead of a credit based system, which means so the debt of the system. That's why they did what they did in 2020 with regard to deficit spending. That's why they're continuing to do the deficit spending, and that's why CBO projections are what they are because the deficit spending is not what people typically think. And the debasement of so this comes back to how we started pre the stream with the debasement of currency. They need to structurally increase deficit spending and keep it elevated merely to supply the system with the instrument that is allowing the system
to
to still
create,
exist.
yeah, because the system can create whatever dollars it wants. They are not in control of the creation of dollars. All they are is in control of the creation of the highest form of said dollars. Like there are different tiers of dollars, right? There are your deposits at the Federal Reserve are at the top tier. Then you've got, collateral like US treasuries, especially short dated stuff. Like that's very money like. You have deposits at banks that have assets at the Fed. Like those are very high forms of dollars. Um but then, then down here at the bottom you have stable coin I minted using a JPEG as collateral.
Oh.
You know, and like everything in between. Um, and the different tiers of liquidity, they're all dollars. They're all recognized as dollars within the dollar system. If I take those dollars, I sell them, I shoot them through Coinbase, I deposit them in my bank. They're still dollars. They're liabilities now of the Federal Reserve.
And
Uh,
further counterparties
indirectly
downstream.
because my bank has a master account at the Federal Reserve. But like this is just how the the liquidity has different shades, but they're all dollars. They're all dollars. And
Is it, isn't it remarkable that it's imperative to understand this, ladies and gentlemen? This is how the system works, and you're going to hate it, and you're going to. Some people will cry about it, and they'll say Bitcoin fixes money. But this, you want to eat tonight, you need this kind of money. You need to, and therefore, if you could understand this, He comes back to like Stan Druckenmiller. The persons that understand this will outperform the persons that don't understand this because this money is going nowhere. And as Brent Johnson talks about, this is the money that will exist into the future for a very long time. And let's be more granular. This system that you're hating right now has strengthened to the strongest point it's been in decades. Right now, this dollar system that needs to be fixed, fix money, fix the world. The world, the planet, which is human beings and countries and all these populations, not only accept this, they're demanding more of it. So you're on the uptrend, and folks are saying it's going to fail. The uptrend is occurring, and Ben, I'm referring to total dollar transactions on the planet, dollar denominated transactions on the planet. I think it's at 48 and change percent last I saw.
Yep.
And that is highest it's been in decades. So Brent Johnson clearly states unambiguously, which is something that I agree with in entirety.
I too am a milkshaker.
Yeah. But before the dollar fails, every other country fails. And before every other country fails, you have intervention from the United States because the United States is dependent on those other countries for imports.
Yep.
Existential, yeah.
And they are dependent upon us for dollars because dollars get them energy in the form of oil or gas, and those dollars are an essential part of that transaction. So
Correct.
by securing dollars, you secure oil, and by securing oil, you secure, economic viability.
You know what comes in right now is Luke Groman. And he's very nicely talked about what China's doing with gold prices, and I appreciate that perspective he offers. So this plays into what I talk about and how I interpret Luke's observations and how I see path and destination. And really, it's surmised by a very simple sentence I say. It's going to get weird.
It
So
is going
you
to
could,
get weird. It is
like
going to get weird.
destination, like BRICS, and then people talk about new types of currency. Okay, great. We have to reinspect. Give it 10 years. Let's reinspect in 10 years, and you'll start to see maybe like structural change like 15, 20 years down the road. But with regard to getting weird, the price of gold is going to get freaking weird. The price of Bitcoin is going to get weird. The price of hard assets are going to get weird. And
Yeah.
it's imperative to understand, like debasement, how Raul talks about it. Who's doing the debasing is such a critical thing to appreciate granularly, the details. The U.S. government barely depreciates the dollar, and that is a very empirical statement
Look at
because
that
the
chart.
vast majority of dollars, that's a remarkable structural structure. The structure is broken, and it's not even from the ascending, the ascending, the rising wedge formation. It's from a level perspective.
I
That
mean,
is a structural breakout as a level break, and clearly you could check back in 5, 10 years for a retest of 2080. If you're a technical analyst, but that is a breakout. The point was, just concluding the point. What was the point I was making? That was a good point.
sorry.
Um,
Luke Groman, gold.
no, Raul.
Oh, Raul.
What was he talking about? Damn it. Anyway, they all make great points. They
They
really
do.
do.
They do. I mean, there are certain aspects of Luke Groman that I don't necessarily buy into. But he uh he is certainly right about oil and the fact that, like, it is an important commodity. Like, real assets are going to be important in the coming decades,
Yes.
because um you know, I think Bitcoin makes an excellent hedge against uh fiat currencies, because fiat currencies are just inherently, based on the system we've created, debasing themselves
Yeah.
through market actors. Because if you mint
Oh.
a dollar stable based off of, using your Bored Ape as collateral, you have created dollars,
Yes,
Bored Ape backed dollars, and uh that created dollars into the world. And what's crazy is that even with all of these dollars being created, this is what the DXY is doing.
relative. Currency is always
Yeah,
relative. Look at
this
that
is
uptrend.
this is
Still in a
relative. So despite the fact that, people are just making new dollars every day using collateral as backing, the dollar's still getting stronger and stronger.
They're gonna have to
And
structurally deval.
ever since 2008, until you get like collateral destruction, uh you are going to just see dollars create dollars, and the leverage will pile up in the system. But that leverage is demand for dollars,
Yeah,
and that demand can overwhelm the uh you know everything, and it can create these periods of time
distortions.
where you get these massive run-ups in the dollar because there's so much demand for dollars, especially when you're raising interest rates. If interest rates are going higher and higher and higher, now the cost of capital grows higher and higher and higher. People need to refinance all of their debts, and doing so becomes more and more costly. And so they need to buy dollars in order to pay off their
Service
debt,
their debt.
service their debt, pay their taxes. And this is where we are
They're
today.
gonna have to cyclically. What's interesting is this: domestic policy versus management of what people call the reserve currency. So, and that's a conflict. So people have mentioned like fiscal dominance and whatnot. That's a good part of what pressures are in the system. I'm more interested in domestic U.S. Consumer pressures, which results manifest in consumer price inflation and a requirement to manage that. And that's clearly what they're battling, versus basically the existentiality of foreign nation states from a functional financial system standpoint. So the dollar can't rise much further. Well, it'd be interesting is to look on, dollar pound cross to see where the gilt crisis was. Because for folks that need very specific statements, when you hear that phrase talked about from macroeconomists, the gilt crisis was the economy of the island or islands, England and Britain in entirety, that entire economy, pound
Yeah,
denominated,
I was right here.
was failing, as in, and when you say a failing, that means ATMs don't spit out cash, truck drivers don't get paid, supermarkets don't get food, and you're entering Immortan Joe territory, where you're where it's post-apocalyptic.
Yeah, yeah. I mean, the the bond market was throwing a fit at that point because this is, October 2022, September 2022, bond market was going crazy because there was a need for dollars.
It's really as simple as that. The art of what we do maybe is to put these charts, these sophisticated terms, into these reductionist terminologies. In March of 2023, if those banks failed and that money became non-withdrawable from those banks, that would have spiraled into a banking panic, which is the early signs of social chaos. And the banks don't put bills into ATMs, and you have a collapse of normalcy. I mentioned to my wife the other night, like after in 2020, not really, but certainly post 2008. No, I'm sorry, 2001. What am I talking about? There's a feeling that I remember from 2001. I was like 18 at the time, give or take. And it was when you're driving in the streets and it feels different. And it's it's when social order is decaying. It's the collapse of normalcy. It's like, you know what I remember? I remember maybe a little bit the experience was 2020 to like 2023. So when you're driving to work and the roads are empty,
Yeah.
or when you go to a supermarket and there's five people in the supermarket, or when you're used to 20, 30-minute car line to drop off your kids and it's 2 minutes and you drive right up.
Yeah.
When normalcy starts to change and it gets weird like that, that's the thing that most people are not uh, uh, seeing as scary. That's scary because that's when people start to behave differently. That's when violence changes. That's when fears and emotions change and people do not normal things.
Yeah. And anyone who's ever taken an economics class will tell you that the entirety of economics is based on the underlying assumption that people will behave rationally. And at those times rationality gets thrown out the window to some extent. So yeah,
Financials is the management of that. So as much
indeed.
as they talk about consumer price inflation and economics and jobs, they're really talking about your neighbor not trying to break into your house
Yeah.
and everyone getting up at 8 a.m. to go to work because that's normal, predictable, consistent, calm behavior. That's it.
Yeah. So I just wanted to point out some more charts real quick, because like I do think there are a few more interesting things to cover, like in the context of all of this. So this is M1, which is basically it's like deposits, in the banking system. It's the domestic forms of money. But I just want people to think about this notion that like it's been down only since basically the peak in the crypto bubble. um and it's been down only in M1 ever since then. However, as the Fed has raised interest rates, somehow all these assets have pumped. Where did those dollars come from?
Ah, that's fascinating.
I mean, where did they come from? They clearly didn't come from the government printing money. They didn't come from the Federal Reserve. Uh, Instead, these are dollars that were born out of the shadow banking system,
Yeah, they're
dollars
born
that
out of
were
Visa and
born out
MasterCard.
of Visa and Mastercard and non-banks and the repo market and everywhere that isn't the Fed.
What's
Um,
interesting though is the net negative on those deposits because it's a good inspection, but like Visa, those they don't always land in deposits, so it's only a small part of total dollar supply. Maybe they end up they purchase something and then they don't end up as a bank deposit.
yeah,
So that's it's only part of the total tapestry.
yep. Another thing I wanted to touch on was just since we just had tax day,
Mm.
figured I'd hone in over here on the good old TGA chart. This is the Treasury General account, the Treasury's account at the Federal Reserve, their checking account where they use to stock up money for spending.
Yeah,
And
the
and
weekly, look at that,
this is the weekly. Yep.
140 bill.
So a bunch of people were paying their taxes here over the last few months and whatnot. But Fed's been spending it,
No, the
and
last week they unloaded a clip, 140 bill. That's a
yeah,
hell of a
and
check.
that was, and honestly, I'm guessing that was intentional on their part to kind of spread those payments out that way, because money that comes out of this is money that has been socked away out of the economy, right? This is a reservoir that is filled up by Janet Yellen, and it when it gets filled up, it pulls money into limbo, out of the economy, where it can't interact with anything else. These are just dollar liabilities that are doing nothing for the world. And they realize this power. They understand this power. Um,
Mm.
and what they've done is probably front loaded a bunch of spending right going into tax day in order to try to offset some of that liquidity uh, problem that happens when you have tax day, right? I
Yeah.
mean, because it is an election year. Everybody, is trying to keep markets as smooth and operational as possible. And, you do a bunch of spending down of the TGA in order to juice things through the hardest weeks for liquidity, because everybody's moving to shorter duration assets and everybody is trying to prepare to pay their taxes, and, you know, got to spend that down, get some money out into the real world in order to help pump things back up.
Where's the Fed
Um,
balance sheet?
Fed balance sheet. There it
Oh,
is. Continuing to run down via QT. Uh, they are running off their treasury assets. They are running off their mortgage-backed securities. At some point, they're going to probably stop with the treasuries, uh, rolling those off of their balance sheet as they mature. Instead of buying new ones, they will just basically do a buyback and burn on those dollars, and they will just write them off the balance sheet and disappear those dollars, you know, until they
what
are needed once again.
what do you think Treasury's going to do? Buy back and burn, because obviously that's like TQE. If you want to talk in you know, uh, what would it be called? XFI, finance on X, TQE, Treasury QE. But they're they're probably going to be changing the composition and getting off the run adjusted to hit their duration, which, as we talked about early in the stream, is composition of money. And as Ben talks about, different degrees of moneyness. Shorter duration has greater degrees of moneyness. So they're probably going to be adjusting the composition of money towards shorter duration. They got to get rid of some of the long duration. They're probably going to buy back the high interest rate bills or the high interest rate treasuries and focus more on notes and bills.
Well, so what they're doing is they're actually doing this. This is another thing that they've been sneakily doing, is they are doing this buyback thing where they are buying back off the run stuff, and they are issuing new treasuries, that which is on the run. So just in general, off the run treasuries are older issued, and it's a lot like um for like if there's a new NFT that comes out, right? You get a lot of volume on that NFT because everybody's got them. There's a whole bunch of them in supply. Not everybody actually wants to hold on to it and keep it. There's a lot of volume changing hands, and treasuries work exactly the same way. Um, and it's the same for anything too, like sneakers. I don't care what sort of illiquid asset you're dealing in. I used to flip guitar pedals. Same thing. Like the same mechanisms are at play here. The liquidity after a new one comes out is at its zenith, And then as time goes on, some of those end up in the hands of strong-handed pension funds or whatever, and those disappear from the market. And so as an asset becomes less liquid, there becomes a liquidity premium that has to be paid in order to buy that asset. And
Term
you can,
premium.
yeah, well, it's not term premium. This is liquidity premium. This is different than term premium because and you can actually see this illustrated most clearly by look at the difference between a 10-year, a 20-year, and a 30-year treasury. So the 10-year is trading at 4.65.
I see.
The 20-year is 4.87 and the 30-year is 4.75. Why is the 20-year yielding higher than the 30-year? It's not because of term premium, because term
Supply.
premium is the cost of time. Term premium is the cost of time. 20 years are far more illiquid. So that difference between a 30-year and a 20-year treasury is telling you that 20 years are far less liquid, and so that you're paying that 4.8 your 87 uh because they're more illiquid. Like
That
you're
is
getting paid for
excellent.
that illiquidity. And so um that
Excellent.
liquidity premium is incredibly important. And what do you think happens when the move goes to the moon on all these assets? Liquidity premiums across the board. They go up.
They're trying to finagle the composition. They're
Right.
trying
And
to
so
adjust the inversions.
right. And so what they're doing is and this is actually honestly smart on the part of the treasury is what they're doing is they're buying up the
20s.
the well not just 20s but like off the run stuff. They're buying up off the run treasuries that have a greater liquidity premium and they're just issuing new stuff that's nice and liquid. And so what
Yep.
the treasury is essentially doing is they are capturing that liquidity premium and they're saving that much money on interest.
They're healing the composition
Right, they're
of
just
the.
keeping the what's on the shelves nice and fresh. They're clearing out the old expired stuff off the shelf and they're putting some nice new stuff.
They're
Uh
fluffing the pillow of the
yeah,
treasury bed, and ultimately that's going to increase the overall moneyness factor of the net
again,
composition of the treasury.
yes, again juicing the liquidity of the treasury market because they have a serious problem here that they cannot get this move down. This
Yeah,
is this is hugely problematic. And you know what? The why did it go down over here? Was it because the things were better back then? No. No. Things freaking broke in '08 and they did massive QE, and then they stopped QE, and then they broke again. And then they started QE, and then they broke again. They don't know how to fix it.
there's no way to fix it. This organic market
It's
is
right.
it's entropy.
You don't need permission to create a dollar. And that is a huge problem because they want to be able to give you permission to create dollars.
That's not something they could solve. That's World Economic Forum talk. But there's a massive difference between. There's no flipping switches in normalcy. You can't just turn one system off and one system on. And that's why I often talk in time frames that are uh, uh, received awkwardly in crypto space because I talk in 4, 8, 12-year time frames. But
Yeah.
that's so critical. So
Yeah.
and it's so critical in crypto terms, ladies and gentlemen, because in crypto terms, composition of the global money tapestry is going to be so remarkably different in
Yeah.
2028, 2029, and dare I talk about like 2032, 33. It's going to get weird. It's going to get so freaking weird, and and this is such an incredible destination for capital. It's the expatriation of capital, crypto markets. It's literally cross-border. It's an emerging market of emerging markets. And what do I talk about? Underperformance seeks outperformance, and I talk about regulatory arbitrage, geopolitical arbitrage, geographic arbitrage, interest rate arbitrage. That's what these markets are now. And it's just it's 4 years in.
Yeah.
Nobody knows about these damn markets, and all of a sudden,
Yeah.
you can
And
buy collateral. There's collateral here, and you
and
can
on
borrow
the
print dollars.
yes, and it's non-dollar collateral. That's the beauty of it. Like I can go on to Aave or maybe soon to be tapioca. Uh and I can mint a dollar stable coin using ETH as collateral. Uh and that means I have an ETH denominated collateral and a dollar denominated debt, and I can pay that back to get my ETH, but it it sort of hedges you against devaluation of dollars or the inflation of other assets allows you to access those capital markets. It's crazy.
Well, technically, it is literally the infrastructure of the system. It is,
Yeah,
by definition, the euro dollar market, the capacity, and it's what Brent Johnson talks about, that dollar lending and using not dollar denominated collateral further strengthens the dollar regime because you have to repay that dollar denominated liability using dollar denominated assets,
yeah,
but your collateral is volatile, not in dollar terms. So it's going to vary in value relative to the dollar. Uh, I appreciate that. And that comes back to my conversations about the resiliency of credit infrastructure and who's taking risk. And that's so critical. We talk about risk all the time. And I think there's a tremendous amount of risk in traditional financial institutions that manage this collateral and issue dollars, whereas there's substantially less risk in crypto markets, which is a really weird statement.
yeah. Speaking of that risk, I want to go back to that in 1 second, but like on ETH, I just wanted to touch on that. Like back in the day, there was this sort of narrative with ETH that ETH is oil and Bitcoin is gold, and I actually don't think that that's too far from the truth
Mm.
in the digital space, because like the ETH required for gas to pay for these transactions to facilitate this economy that's taking place on chain. It requires ETH as gas, and I really do think that there's a very salient like analog there.
Absolutely agree. And you know me, I talk in metaphors all the time. The only way to understand these systems is to digest them in traditional financial and real world terms. Um, so ultimately, it all reduces to buy and sell pressure and where they come from and what's the sustainability of that buy and sell pressure. So Ethereum is still quite interesting structurally. I think it has less of a degree of moneyness as compared to Bitcoin, particularly because of time. And clearly, Bitcoin is still remarkably volatile. And I pretty much wholeheartedly agree with maximalists with regard to their inspection of the degree of moneyness of Bitcoin versus basically everything else. The only thing I come up short with in much of their conversation isn't money. It's the concept of investing. What are you investing in? And what does it mean to be a good investment? And that's just it. Like I'm cool. Listen, you get income denominated in Bitcoin, and you got to respect forex markets and Bitcoin volatility. Um, but if you don't have investments, that's a whole nother conversation.
Yeah. Yeah. Agreed. And so there is a thing that you and I both retweeted yesterday that I thought speaks to the sort of risk of traditional financial markets. Um, and it was talking about this sort of like built up risk in the way that the taxes are counted on ETFs. Do you remember this tweet yesterday?
Oh my God, that was a remarkable article or
Yeah.
series. Tweet storm.
Yeah. So you can follow either of us and find that tweet from yesterday. It was by Phil Back, and he was talking about how there's like $12 trillion in capital gains that the retirement accounts have just sitting there, and this number keeps growing because basically the way it works is, and I cannot tell you why we've ponzified the world this way, but
But you saw that it was because Vanguard patented the accounting methodology for clearing the books.
yeah, yeah, they did. And so um
Quite fascinating.
yeah, and why we allow a patent on something like that is ridiculous, to be honest. And why the SEC, I mean, I think the SEC is purely just scared of the ramifications of everyone all of a sudden clearing their books and what that's going to do. But like, it's created this super Ponzi where basically what's happened is anytime you go into an ETF, right? Um, that ETF buys something. Let's say it's like an oil stock or whatever. Now the price of that thing appreciates as flows come in. They have to buy things, and then as flows go out, they have to sell things. Now they don't actually register any capital gains until they have to sell things, right? And for whatever reason, the way that these stupid things were designed, the what happens is when they sell things, the people that are still in are the ones that hold the capital gains losses. Everyone who sold is off scot free. I mean, they're paying capital gains on the other part of it, which is just kind of crazy in and of itself. Is they're going to pay capital gains for whatever shares they sold and what gains they got out of them. However, the the massive capital gains that were gained by the older people that have been in that thing longer are shared by the new people that just got into it.
You
And
know what's so
so,
fascinating? I absolutely love it because it's tax day, or yesterday was. Uh, that is a deferred capital gains tax liability because of accounting
yeah,
and organizational structure. And it reminds me of like accounting methodologies that are have a capacity to defer capital gains obligations into the future. You report that there's a capital gain. It's probably realized or unrealized in some way, shape, or form, but it's still reported that there was a capital gain. But it doesn't mean there's a liability. There's just subtle nuances to these institutions and their expectations that are just
yeah.
uh, in the end, uh, personal income and personal capital gains. You need to cure that, ladies and gentlemen. That is a problem.
Well, and
There's
and
so
this actually relates back to the Bitcoin spot ETF as well. Because I don't know if you realize this, but the whole like cash settled part.
yeah versus in kind. They didn't want this because if it was this,
No, they do want this. They do want this.
the ETFs want this, but the SEC didn't want them let them have them.
Well, no, the ETFs wanted to leave it in Bitcoin, not have it be cash settled. And what happens is when they cash settle it, it registers that capital gain.
They have to
And then
realize it.
it creates this very problem. So I honestly feel like the feds feel like this is a feature, not a bug,
Mm,
that it creates this sort of like perverse thing where the spot ETF will become less and less capital efficient over time. Or maybe they just want the tax dollars uh, for every one of those sales. Cause like
exactly. Exactly.
if because they cash settle it, as long as you're matching inflows and outflows, like you don't register capital gains. So like let's say 100 people go into the ETF or like $100 million comes in, $100 million goes out because it's cash settled. Now you still have to settle that thing in cash and create a tax liability. Whereas if you didn't and you just said, I got 100 coming in, 100 going out, I'm just going to
Oh,
keep my Bitcoin the same, there's no tax liability there. They have the feds have mandated that they have greater tax liabilities in this ETF structure.
I wonder if it works out the same way where they achieve that deferral by passing the liability on to the
Yes.
currently
Yes, it
existing
does.
shareholders.
Yes, it does.
Interesting.
It does. And so the spot ETFs are great to get into first, and over time they're going to be less and less attractive relative to Bitcoin itself.
Well, that's always going to be the case from
Now, not everybody wants to do self custody and all that, but it is that is what they have designed, because
ay, ay,
the
ay,
Ponzi
they made
must
a mess.
continue.
And the Ponzi will continue because otherwise there's no gas to put in the car for the Congress people to drive to Congress and have a job.
Yeah.
And the snack store downstairs in one of their congressional buildings didn't get deliveries because the truck driver didn't get a paycheck. And
Yeah.
and so,
Now,
and then,
the cash settle thing also leaves all sorts of, you know, opportunity for, you know, grift and yield on the part of the ETF, cuz like, I don't know what sort of market price, and this is probably in the prospectus. I didn't read it that carefully. Uh but like, how are they cash settling that? Like, where are they getting their market quote from for selling those bitcoins into cash? um you know I don't know if they're just going to sell that stuff spot, or if they're just doing this all on a balance sheet and just capturing a spread the whole time as people go in and out.
nah, don't kill yourself on the subtleties of their business structure. What's pertinent is they have a capacity to allow capital flows into underlying spot purchases of the asset that they're managing. And that's all that matters, net inflows, net outflows. And that probably is best expressed in observing that the structure of Bitcoin is very much changing. And Q3, Q4 is going to be very, very interesting. Different amount of capital has a capacity for inflow now as compared to historically. Uh, much, much more gatekeepers, whereas traditionally it had to go through the few centralized exchanges. Now there is the very biggest of exchanges that offer that capital inflow potential.
Yep.
Uh, path versus destination, everything I've talked about over the last year, especially, destination remains unchanged. It's going to get freaking weird, ladies and gentlemen. The amount of collateral that needs to flood the system for the system to remain functional is extraordinary. $10.8 trillion plus 2024 fiscal deficit spending, and all you need is the optimal conditions, or not even optimal, just favorable conditions that aren't
Yep.
stupid. And
And
those
and I was just gonna say, like, this is the move right here.
right
This
there.
is this is
That's
this
it.
is what they're trying to push down.
And that's the conditions. So if you get to 20, you get to 20, Q4 2024, and they basically pushed out probably like 12, $13 trillion out of Treasury, and moves at 80, 60, or move is just down for that matter, you guys don't know what's coming
Yeah.
unless you've seen the awkward. It's awkward. I mean, it's awkward in a good way, I guess, but the frothiness and the exuberance and kids that are going insane over trying to talk on social media about what is a better asset. You can drive yourself nuts over what is a better asset because when this market does what it's capable of with regard to monetization, or at least in response to monetization, this cycle is going to be freaking weird compared to 2020. And especially compared to like mostly 17, but good parts of 16 as well. This is a very different composition of global money supply and very different pipes into Bitcoin and very different landscape of centralized exchanges for pipes into crypto as a whole. Arbitrum didn't exist. Optimism didn't exist. The large swaths of alt L1s didn't exist in 2020. There was no capital flowing into those markets. And now all of these large centralized exchanges offer direct capital rails into markets other than Ethereum mainnet. This shit is going to get freaking weird on chains where there's transaction fees of a penny. And can you
Yeah.
imagine the kids in college figuring out um, cash and carry for the first time, Ben? You remember
Oh
the
yeah.
stuff we did with
I mean,
Aave and
yeah, I mean, that's I mean, some of that is like look at what Athena's doing. I mean, I think they have opened up a bunch of people's eyes to the notion that the cash and carry trade is alive and well in crypto.
oh my God, it's gonna get so weird.
Yeah.
Yeah, it's gonna get so much weirder than 2021. I mean, we had. I mean, it was literally like a frenzy on when not just Curve, but when Aave went over to the likes of Matic, Polygon. I think it was maybe it was Matic at the time, but anyway,
Yeah.
and it was just the looping on Aave and which was just leverage cash and carry, which is exactly what we're talking about, how dollars are printed using bonds at a bank, and they're not
Yeah.
necessarily looping it in the same way.
But
Uh,
you can. You certainly can. You can lever up a US treasury. Like you can take a 1 month treasury and you can lever that thing 50 times if you want. You just got to find the right counterparty and
correct.
they will let you do that.
It's gonna get so
And
freaking weird, and it's gonna be.
and to that point, I just made an interesting observation. So I'm going to go back to the charts here for a second. But if you go back, so like the Fed funds rate, right? So last time that we had what was basically, a pause, right? Where the Fed raised interest rates and then just paused.
Mhm.
January 19th through basically until things broke in September. Um or just July, I guess, is when or August is when they lowered interest rates of 19. So they rose interest rates. They tried to get out of the ZERP and they failed. Um, and that pause, though, what does that do to the demand for leverage? When you know that, okay, the Fed's not going to raise any more,
It's a precursor.
what that does is it temporarily, so looking at the move, this is what happened as they raised. This market became less and less liquid over time as they paused
Yep.
because all of a sudden you didn't have to account for rates changing in the short term. So you could lever with impunity until you became limited by the
About
volatility and collateral in the system.
lack of
So,
balance sheet capacity.
yes. And so what happens is naturally by pausing interest rates, they set off the bomb.
Yeah, National
but
Financial Conditions Index is
but
loose as hell, but that's gonna go
right,
up.
because the private money machine was able to spin into overdrive, creating shadow money until something broke. And I think we're going to see something similar in the not too distant future
Yeah. Curious how
where
they prevent stock market from demonetizing.
probably the same tools they've always used,
Well, they
you
haven't
know.
had. They have more tools than they ever have had, but they. It's not. That's why it's so weird, ladies and gentlemen. They they can't They can't let the stock market demonetize like it historically has. That's exactly why 2020 was a brief dip. Now they're at the point where it just needs to be managed, like literally like a managed currency regime. You can't dip. You could dip with regard to like organic price action, but you cannot structurally deviate. You cannot have minus 30, 40, 50% because that triggers the cascade, and the cascade is not manageable. So that's why we talk in terms of liquidity. If you manage the liquidity, you don't
Well,
have the structural deviation to the downside.
there is a sort of contracyclical effect that happens here because, like, over the years, because U.S. assets have been uh, a cash cow for the Treasury, because they can tax capital gains. So more and more of the money going into the Treasury has become dependent on capital gains taxes. So when you get years where those assets reprice downward, now everybody gets to write those off as losses. And what does the Treasury then have to do? Well, now they're running a massive deficit. That deficit spending means print more collateral. Print more collateral means more private dollars created to pump up the assets. So there's this contracyclical thing that happens where when you get an off year in the stock market, you get an off year in treasury receipts, you get massive amounts of collateral pushed into the system that then surge asset prices further.
It's a leading indicator. So the
Yeah.
leading indicator is bond market volatility collapsing, combined with treasury issuance, which is like gas tanks coming up to the
Yep.
racetrack. And then the move falling over is basically, all right, everybody, get ready.
Yep.
You're
That
going to
means
jump up.
get your cash ready and get ready to pump it into some degenerate stuff because we about to go for a ride. So, like,
It's important that we talk about this because we're saying this on a day where Bitcoin, damn, look at that volatility, 62,000 to 62,300.
yeah,
Brand new,
move going up like this, not good. Not
look at
good for
this
risk assets.
big volatility, big sell-off across the board. That damn wormhole that just launched has gotten neutered from like buck 50 to 58. Jupscan hit hard down below a
Dude,
dollar.
that was one that was like, why does this even have a token? This just
That's
looks
all of
like
them.
but that looks like exit liquidity. Honestly, like Wormhole was like a bunch of jump money and a bunch of big name Sequoia VC nonsense. And you know that when they introduce a token, it's not to decentralize anything. It's so that they can monetize on their illiquid private investment uh, in a way that will help repair their balance sheet.
Well, ladies and gentlemen, this is called exit liquidity for a reason. If anyone's going to spot exit liquidity, it's
Yes,
us.
it is. And W, if you're buying W,
Oh my God.
you are you are the exit liquidity, I'm afraid.
Remarkable. I paid taxes, by the way. I paid taxes with W. That was a very, very, very appreciated gift, ladies and gentlemen, who bought W.
That's funny.
Oh my
That is
God.
funny. All right, sir. Well, I think this one is in the books, and I think that alone should bring us to the until next time.
Until next time, I look forward to it, but hopefully we'll have more favorable conditions.
Yep.
But I'll do some streams later this week, guys, about discounts. There's no discounts in these damn markets. Everything is still at a ridiculous premium. These numbers are quite. We'll discuss it further. Ben, love the time. Always a pleasure with the banter.
Indeed. And yeah, until then, Don't be exit liquidity.
That's right. Peace, everyone.